as Goldman Sachs and Citigroup ended their bets on a falling dollar last week after those trades lost 2.8%. One strategist sticking with his dollar call is Alan Ruskin of RBS Securities. He joins us from Stamford. Alan, welcome to Bloomberg News. Always good to have you on.
Thanks for having me, Mark.
Well, a year ago, you predicted the dollar would fall, but now you say it could soar 22% to $1.10 per euro if Greece defaults. Why the switch?
There has been a sea change, I think, in the global macro picture. So last year, I think we were talking a lot about quantitative easing, and the Fed was effectively printing money. Now they're in retreat. We're now flirting with the idea of higher U.S. interest rates. The U.S. economic cycle is leading the way. The U.S. will, in fact, probably be the strongest of the G10 countries. Europe has got all sorts of problems, and therefore we now have shifted really from what was an anti-US dollar trade for much of 2009 into an anti-euro trade for 2010.
Yeah, well, you noticed, or note, I should say, that a month ago you say that risk appetite was suffering under a cloud of Chinese monetary fallout. What's changed in the month?
Well, I never really bought into the idea that China deserved to be the source of a very negative risk appetite event.
Why not?
Well, I think China in general is still going to grow reasonably rapidly, provided the U.S. is on track. I think the U.S. sets in train the major risk forces for 2010. In 2011, maybe 2012, you have some bigger risks there for China, but I don't think that's a story for 2010.
So are we away from the worst fears, do you think?
I hope so, really. So I think there are still some huge structural problems globally, balance sheet-related problems in all the G10, including not least the United States. But I think the cyclical picture looks much more constructive now. I think we've got some hope now for reasonable growth in the next few quarters, and I think that is supportive for risk. Longer term, however, if you actually look at the fiscal picture, if we ever have a downturn in the near term, if we had a downturn and I was wrong, say, in the next 6 months or so,
right,
then things would get ugly very, very quickly because the sovereign balance sheets are in awful shape, and some of the other balance sheets, even in the financial sector and household sector, are quite fragile. So we really need a period of growth now.
Alan, it's something that I asked our Sarah Eisen. She covers currencies for us. How unusual is it for you to see the dollar and equities moving in tandem?
It certainly had long periods where it has actually seen equities going up and the dollar going up. The pattern that we saw last year was probably more unusual, whereby the dollar was really weakening just on the sort of risk appetite, positive risk appetite story. I think the closer we get to Fed tightening, the more strong U.S. data, things that are helpful for the U.S. equity market will be perceived as positive for the U.S. dollar.
And one of those things that you're talking about, taking a look at the U.S. economy as a whole, those jobless numbers, is that giving you cause for concern? Is that going to put pressure on the currency, do you think?
No, I'm quite hopeful there, really. I'm hoping that we've finally turned the corner and we will actually see positive employment numbers in the next few months. I think this coming non-farm payroll number will be distorted positively by the census count, so we almost certainly will see positive numbers as well then. But I think on a more sustained basis, I think we're going to see jobs growth, and I finally think that that will generate the kind of income and therefore consumption that is this kind of virtuous cycle that propels the recovery forward.
So as far as, if I might switch quickly to what's going on overseas in Europe and specifically in Greece, we're still seeing, at least right now, traders seeking refuge from that crisis?
We maybe are past the immediate worst. So I think there's the sense that there's some financing that is coming down the pike, and Greece is clearly trying to prove that it can finance at reasonable rates.
Right.
My worry is really that there's a much longer-term story here. The story of austerity over a protracted period really means that we're going to go through political cycles where the Greek people might not be too happy with what we see from growth there.
And in about 20 seconds, we should mention that you correctly predicted the currency's decline a year ago, but you likened it to the fall of Rome.
Yes. I think the problem we have really is that a lot of different countries are all in a similar boat, really. They're all in the same sort of Roman boat, including, I might add, really, Italy with its capital in Rome. So really we're talking about countries that are all suffering from sovereign risk-related issues and maybe need to actually print money at a later date if their economies do not recover.
Alan Ruskin, RBS Securities, Stamford, Connecticut. Always good to talk to you. Thanks so much.